let's look at a company in the modern warfare space. First off, of course, read this disclaimer carefully. The modern warfare theme is in the zeitgeist here. By the way, you can see that the average of these mega trends are substantially outperforming the S&P 500. Here's the average, here is the S&P. Yeah, some trends are more powerful than others. If you look at the modern warfare trend, you can go here like this. And here are the companies. These are more pure play military companies. We will in this video look at CACI International. They are what we in what we can call the electronic warfare space. Electronic warfare is definitively the future of warfare. And yeah, this is a major trend. Here you can see the distance from the 52-week lows, 52-week highs. Yeah, let's jump into the... well, let's first look at their website. Okay, here is CACI. They of course have a message about COVID, like every company on the planet. Okay, so these are some of their businesses. They are in the C4 ESR and cyber. Let's go to what we do. Okay, so business systems and BPS, C4 ISR and cyber, engineering services, enterprise IT. Basically, what we can call this is electronic warfare. Okay, this is the future of warfare, which is beneficial for the company. And from an investing standpoint, if we go here to the About page, let's just go through this and this just quickly. CACI is a $5.7 billion company whose mission and enterprise technology and expertise play a pivotal role in our national security, safeguarding our troops and enabling our government to deliver cost-effective and high-quality support for all Americans. This is, where is it? If we go here to their main site, the front page. Yeah, so they also offer these services for U.S. government agencies, hence it's not like a pure warfare play here, which of course is good. They are diversified. Here you can see some of their history, some of the executives. All in all, this is a very interesting company, and we will first look at the charts. Then we will look at the seasonality of this stock, which months it usually performs well, then the fundamentals. Then we will have an educational segment, very important, about short selling. And then finally we will look at the S&P 500 to sort of like get the big picture. These are weekly data points. We go all the way back. We can go super far back, but let's go back to like 1994. Here we have the dot-com bubble. It did pull back then. You can see that it reached a high very early in the ensuing bull market in 2004, and then it had a major decline over. It wasn't a very long bear market. But you can see that the gain is pretty substantial of the financial crisis lows. Up to this high was 738%. Really impressive. You can see that there is some seasonality here, some seasonal patterns. That's interesting. Let's look at some time cycles here, like this. Here are the time cycles. Let's see if we can find some clear cyclicality. So here's a rising, declining, very clear cycle patterns: rising, declining, rising, declining, rise, decline, rise, decline, rise. Yeah, we don't really have that much of a decline here. So you can see that the cycle patterns worked really well until this move, when the cycles were a bit disrupted. And also due to this surprise event here, with the virus. But this is a clear illustration of cycle patterns. That's interesting. Looking at the technicals here, you can see that we do have some clear resistance at the 20-week moving average here in purple. For all intents and purposes, you could make the case that the bulls are basically in control, but they have a weaker hand than they did. The issue here is that we are in a battle zone. So this is a warfare stock, and this is a war between the bulls and the bears. Support here, resistance. So we are a bit stuck, but this is one of those to have on your radar for a potentially more substantial move. The correlation with the S&P 500, it is at 87%. So that is a strong correlation. Though if you look at this pullback and overall performance of the stock, it is definitively outperforming the S&P 500. Okay, but that's something we can look at in more detail. Okay, so let's jump to the daily data. Well, let's quickly look at the accumulation distribution line here. You can see that during this, you can see that the AD line is almost as high as it was back here. That is a good sign, meaning the buyers are certainly stepping in. Here are the daily data points. Here again, this is a war zone. We do have resistance here, 100-day, and we have support at the 200-day moving average. So this one is more bullish than the S&P because we have reclaimed the 200-day moving average, and but we are stuck here in this pivotal price zone when there's been many battles in the past. There are option strategies that enable you to benefit from sideways movements. That could be prudent in this case. Otherwise, I would prefer to sit a bit on the sidelines, because these kinds of battles, they can take some time to resolve themselves. The thing is that if we do get some further deterioration, we could have a very good short selling opportunity for CACI, which would be temporary. So even though long term I'm definitively bullish on CACI, there could short term be a bearish opportunity. That's because of the head and shoulders pattern. You have a shoulder, big head, and if we do get some breakdown here, you will have a very clear head and shoulders pattern. This pattern is so clear that the vast majority of algorithms will easily detect it and take advantage of it. So watch out for this one. Of course, a breakout above here would be bullish, and then it's all about being long. Let's look at some seasonality. Okay. Here is the between 1990 to 1994. We are in May. You can see that June, characteristically, it's a decent month. Let's now jump to 1995 to 1999. Here again, June 8, so this is the percentage of months in which CACI closed higher than it opened. So you can see that June is one of the best months. That's interesting. That is, to the bulls. The bullish side. Let's go to 1990, 2000. Here again, you can see that August very strong, but then here again, June is one of the strongest months. Let's jump to 2005, like that. In this period, but here you do have a major bear market. In this case, you can see that June actually was a very weak month. Let's now jump to 2010. Here again, you see that June has become, there's been a big change in the seasonality. That is quite interesting to observe. And here is the more recent developments from 2015 to 2019. May is characteristically strong. June is a decent month. But July has historically now been very strong. So there's been certainly a shift in seasonality over the ages. Back in the day, June was very strong, then it became a very weak month, but now it seems to be... it's not one of the strongest months, but you see that it does tend to favor the bulls 60%. Let's look a bit more closely at the fundamentals, looking at the numbers here. Okay. Here is the analyst recommendation, 1.9, which is a buy rating. What is quite interesting here is actually the target price. So these are the analyst mean target price. So the target price here is $294-ish. The current price is 242. If we do the math, that means that the target price is 21% above the current price. That is, of course, to the bullish case. So that's interesting. Here we can see some performance data. If we go to CACI.com, there is further evidence for the bulls. You have a number 3 hold, which is not, nothing interesting there, but you have an A value score, A growth, and C momentum. So that's really good. Strengthening the case for the bulls. Here you can see CACI compared against the S&P 500, the mid cap and the small caps. Here's the percentage over this time period. You can see that overall it does very significantly outperform the S&P 500. Okay, so to sum up, I think that if we look at the technicals and the fundamentals, the overall picture is it is in favor of the bulls. The bulls do have a stronger hand. There is one big but. The big but, at least looking at the coming months, because long term I'm clearly bullish on CACI. The big but would definitively be the head and shoulders pattern information. If we do get some weakness here, there will be a very textbook, super clear head and shoulders pattern. Given that the markets have become so dominated by algorithmic trading, there will be tons of short sellers coming just automatically into and attacking CACI. So the coming days will be very important actually for CACI. Head and shoulders pattern confirmed will be obviously set up for a short position. Okay, so let's now talk a bit about the importance of short sellers, because short selling has a function in the market, and I would argue that one of the biggest defects of the financial markets is that it is too difficult to be short. There's a very bullish bias, and that creates price distortions. And this is one of the primary reasons why we have these major bull markets and devastating bear markets, which long term are very problematic for financial markets. Short sellers, they are basically the referees in the market. And they do create a healthier debate, because if you have people just flocking to the bullish side, it basically means that you have a strong bias to the market direction, and when there is a pullback, it's going to be much deeper than it would have been if there was more balance. And if you view it from an environmentalist perspective, the bullish fanaticism of the markets, it is intimately related to the capitalistic paradigm after the World War, which was all about growth and debt. It is addicted to growth and debt, eternal growth and debt, even to the detriment of everything, the planet, you name it. It is just pure addiction. It is very important to remember that there are many different kinds of capitalism. The current model is just one of them. And historically speaking, there are very strong reasons to argue in favor of the other models we have had in the past. Because some people make the case that the current system is the worst except for all the others. That is bogus. There have been quite a few systems in the past that were arguably superior, primarily because they were far more long-term. The current system is super short-term, and it has this very strange belief in magic, basically, because the current idea, well, the defense against the critique that the market is very short-term is that the market will solve the problem. So if there is a problem with the environment, ecology, then the market will find a way. The invisible hand of the market. But the thing is that the invisible hand of the market might just be that. It might be invisible, maybe it doesn't even exist. If you look at the obesity epidemic, the market has just made Americans and many people more and more obese. Hence, the market is not even close to finding a solution to that problem. The magic hand of the market is actually making people more obese. So, be critical, okay? Don't fall for... Question all paradigms, especially those who are dominant, okay? More accurate price discovery. Okay, that's one of the big benefits of short selling. Better price discovery. They separate the wheat from the chaff. Bubbles would be more common if people only profited from rising prices. Yes. Hence, the current presence of short sellers. They do have a moderating effect, but I think that short selling should be far more available. I think that short selling should be something that is a natural part of a retirement accounts and stuff like that. By having to buy back in order to lock in profits, short sellers prevent price collapses during a market crash. Yes, that's beneficial. So here are some pros and cons of short sellers. The pros. It is a very direct way to bet against the market or a sub-industry, sector, you name it. Many liquid products are available for shorting. There are some cons. The risk is unlimited, meaning if you are short selling some super speculative micro-cap nanotech company and then they have a breakthrough development in their drugs, then you are going to be shredded. To responsibly hold shorts overnight, you should definitely have access to pre- and aftermarket trading. Let's just super quickly look at the S&P 500. The market is closed today, so we can look at the futures. The futures today are they are bullish. There is a bit of a breakout here. We are heading into resistance at the 200-day moving average. I am still of the opinion that it doesn't make any sense that the longest bull market will be followed by the shortest bear. Hence, I do think that this is a rally within a bear market. Then again, do not bet against the Fed. Be very careful about that. The market will soon tell us the conclusion. Whatever you do, of course, let the trend be your friend, especially in these very, very volatile times when there is a lot of factors impacting the market that are distorting price action. This is why true diversification is very important.